If I ask you what it means to be disabled, most people will probably say that it means being unable to work at all, usually because of a serious injury or illness. And honestly, it's a very reasonable way to think about it. That's how the word is used in everyday conversation. Where things get tricky is that insurance companies may be using very different definitions. And that difference, sometimes just a few sentences buried in the policy, is what ultimately determines whether a claim gets approved or denied. Hi, my name is Vlad Shafir. I'm a financial advisor with Forest Hills Financial Group in New York City. A big part of my work is helping people understand the true financial risks that aren't always obvious at first glance, especially when it comes to protecting their income. Disability risk is one of those areas that sounds simple on the surface, but gets complicated very quickly. Most people expect disability insurance to work in an intuitive way. If you can't work, your policy pays benefit to replace part of your income. That assumption makes sense. But in practice, whether benefits are paid has as much to do with the diagnosis itself as with how the policy defines disability. Let me give you an example that makes this easier to picture. Imagine a surgeon who develops a hand tremor. The medical condition is real, and it prevents the surgeon from operating safely. Most people would hear that and immediately think, of course that person is disabled. But in the insurance world, the outcome of the claim can look very different. Every disability policy is really trying to answer one basic question. At what point do we consider somebody disabled that claims need to be paid? What surprises most people is that this question isn't answered by medical facts alone. Disability claims are also evaluated through the lens of a legal contract. So if the condition is clear, benefits are only paid if it meets the policy's definition of disability. That matters because real life isn't black and white. Disabilities don't always mean someone can't work at all. Often it means they can't work the way they used to, or they can't work in the same capacity, or maybe they can just work fewer hours. And that's why the definition inside the policy carries so much weight. To make sense of this, let's walk through the main disability definitions you're most likely to encounter, starting with the strongest. Of course, there are other types, and we'll just cover a few basic ones. So the first one is true own occupation. It's generally considered the most protective definition. Under this definition, you're considered disabled if you can't perform the material and substantial duties of your occupation, the main responsibilities that define your job. And benefits will continue even if you receive income from another source, if you get another job or change your career completely. Going back to the surgeon example, a true own occupation policy would pay full benefit even if that surgeon decides to teach, consult, or even work in a non-clinical capacity. The policy is designed to protect the profession that requires years of education, training, and experience. And that said, not every occupation qualifies for this type of definition. Modified own occupation sounds similar, but it comes with an important limitation. Under this definition, benefits are paid only if you can't perform the own occupation and you are not working anywhere else. So if the surgeon takes another job under this definition, even one that pays much less, benefits may stop. This type of coverage still offers protection, but it gives you less flexibility. At the most restrictive end is the any occupation definition. Under this standard, you're considered disabled only if you can't perform the duties of any occupation that you're reasonably suited for, based on your education, training, and experience. In that case, an insurer may decide that while surgery is no longer possible, teaching or administrative work is still an option and therefore deny the claim. This becomes especially important when we're talking about disability insurance through work. Many employer-sponsored plans start with an own occupation definition and then switch to any occupation after a certain period, often 2 years. This structure is very common and many people don't realize it until they are already in the middle of a claim. Benefits can end even though medical condition hasn't improved, simply because the definition has changed. And this leads to an important distinction. Employer plans are designed to be one size fits all and are controlled by the employer. Individual policies, on the other hand, are contracts between you and the insurance company and can be structured around your specific occupation and income. Definitions matter even more when you consider how disabilities usually unfold. Many people don't stop working overnight. Instead, they may slowly cut back their hours, give up certain responsibilities, or see their income decline. In other cases, someone may be fully disabled at first and later return to work on a limited basis. Because disability claims are reviewed over time, the policy definition determines whether the benefits adjust for the situation or whether they stop entirely. That's where residual and partial disability provisions come into play. These provisions don't require total disability. Instead, they focus on income loss. So if your earnings drop by a certain percentage, often around 15 to 20%, the policy can pay proportional benefits while you continue working. The residual provisions tend to reflect how disability affects many professionals in the real world. Stronger definitions and better features do cost more, and that's intentional. They provide broader, more reliable protection that aligns with the career and income you've spent years building. Understanding this before something happens gives you clarity and peace of mind. Most people only review their coverage after they are already dealing with a problem, when their options are limited. Taking the time to ask the right questions earlier can make a meaningful difference. If you are reviewing your coverage or considering a new policy, there are two questions that matter more than almost anything else. First, ask to see the exact policy language that defines disability for your occupation. Second, ask whether that definition changes over time, and if so, how. If you already have coverage, it's worth pulling out your policy and looking at it closely. Review how disability is defined, check whether the definition changes, and see whether residual or partial provisions are included. You may find that what you have is solid, or you may notice gaps that deserve attention. If you want a second opinion, that's something I help clients with all the time. I work with professionals, executives, and business owners to review disability coverage as part of their broader financial picture, alongside income, assets, risks, and long-term goals. If this was helpful, feel free to leave a comment and share whether you've actually reviewed the disability definition. If you'd like to continue the conversation, you can reach me at vlad.shafir@fhfg.com or connect with me on LinkedIn. Thank you for watching, and I'll see you in the next video.